Hello, Principles of Finance class. I didn't get all of the material I wanted covered in our Zoom meeting on Friday. I thought I would go ahead and put out some short videos, kind of going over some of the big ideas that we have lined up for us in, especially as you're approaching the test that you're going to take later this week. I made a few minor modifications to the test as I was finishing it up as well. Gave you guys just a few more minutes to work on it. I think now it's at 35 minutes. Multiple choice questions on it worth 2 points, and then there are some short answer questions worth 6. But I really want to make sure that we're covering the material that's in these notes. And so today, I'm going to do a short video, hopefully get one tomorrow as well. So these would be good, especially as you begin studying, going over those review guides instead of wandering through the PowerPoints. Hopefully I'll hit on some big ideas that we'll be covering in this class. So this first one is this idea that, let me share my screen. Yeah. Okay. Yeah. The first one is the idea of just kind of how, again, we're talking landscapes, how it's all set up. Not exactly the view I want. Oh, well, we'll go with it. Landscape of finance and the infrastructure of it and how it works. And so you need to understand a little bit of just what markets are in order to get there. And so today I'm going to do my best to try to describe exactly what markets are. And so in this PowerPoint, it talks about market makers and money, basically people who go out there and match us. And so, I hope I'm not getting ahead of myself. So you basically have what we usually refer to as the market, which is referencing the stock market. And there is basically a meeting place for people to buy and sell the great American companies. And it happens millions of transactions a day for billions and trillions of dollars worth. And it's instant and it's seamless. And so how do we get there? Well, you have to understand a little bit about that process. So if you wanted to go buy and invest in the stock market, you would need to go first to a brokerage. A broker is someone who is willing to help you gain access to the stock market at large. And so you maybe go to a discount broker, one you'd find online like TD Ameritrade. Let's say you'd want to invest in a company like Facebook or Meta, is what it's officially called. So you would go to the brokerage, you'd fund the account from your bank, and then you would ask to put in a purchase for Facebook at, say, I don't know where the stock is now, but let's say $200. And so let's say you wanted to buy 5 shares. So you're going to spend $1,000. So that brokerage, okay, is going to send that transaction basically into the market. I know it doesn't always work that way, but for practical purposes, we'll treat it like that. And what the market does is it matches buyers and sellers. And so there's these people out there who are willing to take all of the people willing to buy and all the people willing to sell, and they're going to try to match those buyers and those sellers. It doesn't always work perfectly, though, because sometimes people are in the aggregate going to ask for a little bit more when they're selling, or they're going to want to buy a little bit less. And so it's the market maker's job to kind of match and pair those up. And so you see, we call that the spread, the difference between bid and ask. And bid would be what you say whenever you want to buy a stock, and asking is what you're saying when you want to sell a stock. So you actually, the terminology is hit the bid and take the ask. So anyway, you have these market makers there, and their job is to facilitate securities transactions. And so the brokerage will send that transaction through a market maker, which then once you find a match, a pair, basically, and this is all aggregated, but for your purpose, you've got 5 shares of Facebook at $200 a share. It'll get sent then into either one of the big exchanges. This is the New York Stock Exchange. This picture is a little dated. And that is kind of more the traditional setting for stocks being traded. The NASDAQ is all digitized, but it is the more newer techie kind of option for trading stocks. Those aren't the only places in markets. Matter of fact, you have some like in Chicago. This is the Chicago Mercantile Exchange, the Chicago also Options Exchange, CBOE, exists there. But anyway, all that being said, you also have the Amex and some other smaller exchanges for the market. But that's what a broker does. Okay. He helps us facilitate that process. Okay. And in order to understand that, that's kind of this picture, right? Here's you want to buy a stock, you go through your brokerage, then the money market maker will help pair you with buyer and seller and send that transaction over. And it's kind of interesting, but it's true. Anytime your money touches hands or anything, right, people are going to be involved in making a little bit of money through that process. And so like market makers make money. You see the guy with two phones up, right? Like a buy phone and a cell phone. They do make a little bit of money on each of those transactions. It's just the way it is. And it's small, and sometimes it might even seem negligible, like hundredth of a penny, but they do so many trades in the aggregate that they do just fine. So that being said, okay, we have different types of orders that we can put in when we're investing in the stock market. If you wanted to buy that stock instantaneously, we put in a market order. And a market order says, I want to buy it now. Oftentimes, it's not the best option for investing in the market because you're going to get these market makers, right? They're going to pair you with a seller, and that seller is usually going to want their price of their product to be higher than what you want as a buyer. So because of that, we have these different ways that you can purchase stock. One is a limit order. The limit order is basically you specify a price, at which point when that stock hits that price, it will trigger the transaction. Okay. And so say I wanted to buy Facebook, but I don't want to buy it. Let's say the stock price is 202. Well, I put in a limit order for 200 under the 202. Hoping that when the stock goes down to 200, it will happen. Now, the caveat there is it might not ever happen. You might not be able to buy if it never goes down below that point. So when a stock transaction goes through, it takes a little time to settle. And that means like, officially be registered in an account. For all practical purposes, at the point of transaction, you own the shares, okay, and the rights and privileges to its growth or its decline, but it won't officially settle in the account for 3 days, which is pretty typical. When money gets wired and sent other places, transaction plus 3, meaning 3 days to settle, is pretty common. And that's how, for the most part, stocks work. Again, this is kind of more of the behind the scenes stuff, but things that definitely do help us understand how markets work. Little joke there. These confirmation statements are kind of old hat. They're mentioned in the text and there's pictures of them, but you can see example of kind of what that would look like. All right, between the cost of the product that you're buying and then the commission cost. And it's interesting because like you may have heard of Robinhood, the trading app. That's really changed the way that trading on the market is seen. And very few places charge even any commission now, which is a one-time cost of transaction to buy or sell stock. Here you can see on this old-time slip, it was $51. And that was common back then, especially in like the 70s, 80s, and early 90s. You wouldn't be able to buy or sell stock with anything less than a $50 to $100 commission cost. And now that was free, which is kind of cool, at least on most places. So here's a little bit about the cost of investing, right? Commissions go to the brokers who are dealing with that. Oftentimes the spread is going to be made by market makers. And ultimately you're just hoping to get in to the stock so you can see it grow, increase in value, and hopefully sell it at some other point. So that being said, we want to go ahead and talk a little bit more about the different ways people can invest. So you talked about, again, in our example, Facebook, spending $1,000 on that. Like if you fund an account, that's a traditional investment, right? You have the money, you want to see it grow. That's not the only way you can do it. Okay. As a matter of fact, here's a picture of a piano with a really cool and very efficient little pulley system that they've designed in the 1800s, right? And my statement here is basically that they're using leverage, right, to pull a piano up higher than they would be able to pull themselves. And in the world of finance, leverage is very popular. Leverage being this idea that we're actually going to go out and find money that's not ours to fund our investments. Okay, we're leveraging a little bit of our money and a lot of borrowed money in a hope to make outsized gains. Okay, now there's challenges with those things. Okay, leverage can crush you if a piano's underneath. If you're underneath the piano getting pulled up to that second story window, I wouldn't be one of those guys standing there, right? But nonetheless, it does happen. So the same thing can take place with your money. When you leverage your money, you go out and borrow money with leverage. It could eventually bite you in the rear, which does happen because when stocks go down or go to zero, then you are held liable for not only the money you had in it, but also the money that you had borrowed. So when we use leverage with stocks and borrowing funds, we typically say that that's a margin account. We're buying on margin, okay? And there's a lot of rules that go along with this. It becomes complicated for the practical everyday investor. It's not a good idea to bet on the market with leverage and have a margin account because you really don't have any need for that. You're looking to invest. You probably want to just see your funds grow for the long haul. You're not there to get reap the big gains from this or from that. And so you can see a little bit about what margin accounts are. A lot of times you have a specific amount of money that has to be yours in ratio to the amount that you borrow. And if a stock goes south, you have to actually start funding it more with your own money. You call that a margin call. And so like in the Great Recession about 15 years ago, like margin calls were happening all over the place. The bank was basically telling, or the brokerage was telling people, you need more money in your account right now. All your numbers are off and you got to throw more money at it. And so a lot of people went broke because of things like that. A little bit more just about market vocabulary. All right. We can call, there's different ways to make money in the market. Let me put it that way. You can make money when the market goes up. You can also make money when the market goes down. Okay. And we call that the idea of basically we call it going long or going short. When you go long, you're looking to buy a stock, hold it, and hope that it grows in value over time. And there's the alternative of that is called shorting stock. And I know it seems a little bit odd because it's a little bit different than what you do if you say go to a store and buy something. Shorting is like trying to make money on an item if it was to lower in value. So how would you do that? How would you make money on something if it was to lower in value? Well, we'll talk a little bit about that here in a second. Usually, typically, people who go long want to see the stock market go up. They're bulls. There are some people out there who just make money when the market goes down because they buy short positions on stocks or the market, and they are called bears. This is an old saying that kind of people who are interested in those terms goes back to the wild, wild west when they would put a bull and a bear in a ring and let them kind of fight each other for entertainment. And you can imagine if a bear is successful, he's probably pulling that bull down. If the bull's successful, he's pushing up with those horns into the bear. And so you get the idea of up and down there. So if you were to make money on the market going down, okay, how would you do it? Well, this is important and it's something that I want to go over because it's going to be on your exam, okay? We call it, again, selling short, okay? You're a bear and you're hoping the market's going to go down. If you absolutely knew the market was going to go down tomorrow, how would you make money doing it? Well, here's how you would do it. All right, you would sell the stock short. And that process is like this, okay? You would go out and you would purchase shares of a stock. Let's say, for a fact, that Carnival Cruise Lines is going to drop by 50% tomorrow. Okay, here's how you make money doing that. You go out, okay, and you purchase the shares of, I'm sorry, you borrow the shares of Carnival Cruise Lines, okay, from somebody out there who already owns them, okay? Then after that, okay, after you have borrowed those shares, you turn around and immediately sell them on the market to somebody, anybody, whoever that wants to buy it, okay? So now you have borrowed and sold the shares of Carnival Cruise Line, and you have an IOU to someone out there for all however many shares you had. When the market goes down, you then go out to the market and you buy those shares of Carnival Cruise Lines that you had sold for more. At that point, you return those shares to the person that you borrowed them from, and you've just made money. So that's how short sales work. And I do want you to know that because it is an essay question on your test. How do you make money when the market goes down? What is the process of selling short? I want you to understand that, right? So it's really simple. Okay, one more time. Borrow the shares and sell them immediately. You wait for that stock to go down in value, and then you buy them back, return them to the person that you borrowed from. All right, let's move on. Here's some examples of measures of security prices, right? So again, if you see this word securities, you might get hung up on that. Don't, all right? We're just talking about securities are stocks. All right. We have kind of measures that we use, the most popular being the Dow Jones Industrial Average, okay, which tracks like 40 of the biggest companies in America. They're supposed to be good representations of kind of our economy. It's kind of an old school metric that people still follow because it's, I don't know, it's kind of the tradition. Nowadays, the S&P 500, the 500 of the most representative companies in America stock exchange is probably the best measure of how the market's doing. But then you have some others as well. The New York Stock Exchange Index, the NASDAQ Index, the 500 and Russell. All right, basically those are just different ways that you can track the market, okay? So how do you look at the collection of stocks? If you're saying, what is the market? The market is all of these different stocks. Well, how are they doing? Well, you have to basically take a section of that, an index of it, to help us understand just exactly the numbers behind those things, okay? And so you build an index that is what you do there. And so you also have foreign companies that you could invest in America, okay? Through these things called ADRs. Basically, it just means that those foreign companies are trading on our, exchange, and there's a lot of them out there. You think about like BP, British Petroleum, Volkswagen, Nabisco. There's a lot of them out there that are very popular household names, okay? And so finally, and we're kind of wrapping up here, it's easy for us to say, hey, here's kind of the workings of the market, but there's a lot of ideas, big ideas behind it, one being this idea of efficient markets, all right? And efficient markets tell us that the stock market is a collection of millions and millions of very bright people in their minds buying and selling that which they think is worth this, worth that. And so the efficient market hypothesis is this idea that markets operate very efficiently. And so because of that, it's really, really difficult for us to go out and game the market, make money, or outperform the market. And so because of that, it's best to invest in low cost index funds as opposed to investing in several different stocks or day trading, where you buy and sell stocks on a daily basis. All right. Instead, don't try to do that. Just try to, put your money into the broader indexes at large, because that's probably what you're going to do, where you're going to be the best at. The markets are very efficient, okay? Not perfectly efficient, but very efficient. And so that these are kind of the assumptions that we follow with that. Current prices properly value a stock. You cannot expect outperformance because of that, at least in the long run. And there are exceptions and anomalies to that in the market that we look at as well. And so here's a good summary of the things that we've kind of went over. Hopefully this will help you understand more about the markets. If I were you guys, I would definitely emphasize as you study for your exam, the concepts of short selling and then also efficient markets. All right, that's all I have to share with you guys. Thank you.